Well, it looks like we're finally nearing the end of the US government shutdown, and the market seems to like the news of that. We've seen multiple stocks climb higher on the day, with the largest company in the world, Nvidia, climbing over 6% in a single trading day. And with this recent news, combined with the fact we're leaving a pretty strong earnings season, we've also seen multiple high-quality dividend growth stocks increase the amount they pay out in dividends, with a few of them growing them by over double digits. So in this video, we're going to be looking at 5 stocks that just recently announced dividend hikes. To analyze these stocks, we'll be using the spreadsheets and the ticker data add-on from tickerdata.com, which you can check out at the link in the description. There's a 7-day free trial. Coming in at number 1, we have ExxonMobil, who just announced about a 4% dividend increase. And if we look at ExxonMobil in the last year, they're down by around 2.4%. Year to date, up close to 10%. Now, if we look at the last 5 years, they've done really well because 5 years ago was 2020 when oil prices were incredibly low. But if we look at the past decade, they're only up about 48% if you don't include the dividend. Now, if we jump over to our dividend breakdown sheet, let's take a look at ExxonMobil. The data will load in thanks to ticker data, and we can see the starting yield is around 3.35%, and there's certainly a history of growing those dividend payments over time. Now, one of the things we can see is dividend growth really slowed down during 2020. It looks like we had about a 1 cent increase and then maybe a 5 or 6 cent increase as well. The 5-year dividend CAGR is only 2.6%, and the 10-year about 3.2%. So in reality, they're growing the dividend slightly faster than inflation. So the dividend is growing, but in real terms, it's not very fast dividend growth. Now, there's plenty of people who love oil stocks, but personally, I have some concerns because there's some major cyclicality when it comes to these businesses. For example, if we jump over to our free cash flow analysis sheet, here's one of the things that I just have to point out. I think this is so important to understand, but look at the free cash flow breakdown for this stock. We can see free cash flow can grow and it can shrink rapidly year over year. In 2020, we saw free cash flow go negative $2 billion. In 2014, it was all the way up to $12 billion. 2024, it was about $30 billion. So we're talking about a wide difference. Look at this. In 2020, again, negative 2.6, and by 22, it was up to $58 billion, pretty much a record year for ExxonMobil. And a large portion of this is driven by the free cash flow margin. How much free cash flow is the company generating for every $100 in revenue that they generate? You can see 2021 and 2022 were very high margin years, unlike 2020 where the free cash flow margin was negative. So again, it's certainly an interesting business. It's done really well over the last 5 years, but it's very tied to commodity prices. Next up, we have a large dividend increase from Snap-on. They grew their dividend by about 14%. And if we look at the last year, they've lagged the market down about 5%, and year to date, pretty flat, up only 1%. But they've done quite well in the last 5 years, up close to 100%. So let's go ahead and look at those dividend metrics. What we can see is, yes, the yield's pretty solid at about 2.84%, but the dividend growth has just been tremendous over the past decade. A 10-year dividend CAGR of over 16%. And in the last 5 years, it's been even faster at nearly 17%. So look at this. In 2014, they're paying out about $1.85, and by the end of 2024, they had paid out $7.72, now sitting at around $9.76. So it really is mind-blowing dividend growth. And the question we always have to ask ourselves, is that dividend growth sustainable? And the way we tell whether or not it is sustainable is by looking at the free cash flow payout ratio trends over time. And what we can see, it's pretty much stayed in that range of around 35 to 40% for the entirety of the past decade, with the exception of 2022, when we saw that drop in free cash flow. But since then, free cash flow has recovered, and the company actually just recorded record earnings per share during Q3, their most recent earnings report. So really, the dividend metrics look really good for this stock. It's incredible. Low free cash flow payout ratio, a decent starting dividend yield combined with rapid dividend growth that is backed by growing free cash flow. If we look at the stock screener and look at this company, what we can see is revenue per share has taken a pretty solid jump up since 2020, and earnings and free cash flow have followed. Now, there's a couple of different reasons for this. Yes, revenue's grown at a healthy rate, but look at the margins. Margins have been expanding. The 5-year average gross profit ratio is about 50.85, which is higher than the 10-year average, and in fact, last year it came in at nearly 52%. So when top lines are growing at a healthy rate and you have margin expansion at the same time, and the stock is also buying back its own shares, what you get is free cash flow per share growing at a much higher rate than top lines. Now we come to our first real estate investment trust on the list, and that's going to be Simon Property Group, and they announced a dividend increase that's going to hike it by about 4.8% year over year. Now, if you know anything about REITs, a 4.8% dividend increase is actually pretty fast dividend growth because we have to remember, REITs are structured differently. They're required by law to pay out 90% of their earnings in the form of a dividend. So 4.8% dividend growth is pretty solid. Now, if we look at this REIT in last year, it's only up by about 1% and year to date up by about 6.3%. But look at that 5-year performance, up 132%. This is one of the best performing REITs during that time period. Now, what's interesting about this is we can see the starting dividend yield, yes, it's high at about 4.8%, but if we look at the 10-year performance, it's actually down by about 5%. Look at the huge sell-off we saw during 2020. It took a significant amount of time for this stock to recover, but if you're able to buy the lows, you are handsomely rewarded. Now, during this time, look at the dividend history. We can see they actually reduced their dividend during 2020, which if you were a shareholder during the time, was obviously pretty devastating. But this was able to reduce a lot of the leverage for the REIT at the time, which was that allowed them to grow at a healthy rate again, and it's the reason they've been able to grow their dividend at a healthy rate again. So again, the dividend cut is never ideal, but it was certainly the best choice in the case of this REIT. Now we come to another large dividend increase of around 15% coming from a utility stock. That's Atmos Energy, a 14.9% dividend increase. And like most energy stocks, like a lot of utility companies, they've done really well in the last year, actually outperforming the market up nearly 22%, and year to date up nearly 28%. So just an incredible run that these stocks have been on year to date and over the last year. There's a lot of demand for these energy stocks right now. So let's just take a look at the dividend metrics. Now, what we can see with Atmos Energy is the starting yield is close to 2%, and the dividend growth has actually been pretty impressive for a utility stock, sitting at about 8% over the past 10 and 5 years. Now, what's interesting is, like we just saw, the most recent dividend increase was nearly double that, at almost 15%. So dividend growth is actually ramping up. And we can see, again, there's a clear history of growing those dividends at a very stable rate. Now, you might be concerned because you see this negative free cash flow payout ratio, but that's actually pretty common for these utility stocks that can be very capital intensive. When it comes to utility stocks, most of the time we want to pay attention to the earnings payout ratio, which in the case of ATO is sitting at just 47.27%. And if we go ahead and jump over to our stock screener, let's take a look at them again. Down here is exactly what we want to see. Look at how stable the EPS growth has been over the last few years. For utility stock, this performance has been pretty impressive. And lastly, we have COP with a 7.7% dividend increase, which is pretty solid when we look at that starting yield here in a moment. Now, this stock has sold off pretty significantly in the last year. It's down by about 21.5%, year to date down by about 11%. But if we look at the last 6 months or so, the share price has been somewhat stable. We can see a little bit of a drop in the last month. If we go ahead and look at those dividend metrics, what we can see is the dividend history stands out a bit. It looks a little bit funny. Why is this the case? Well, to start, let's take into consideration what type of business we're actually looking at here. This is an energy stock. This is another oil company. And so what do we know about these stocks? The underlying fundamentals can be pretty volatile. Again, if we look at the free cash flow analysis sheet, what you'll see is the results look very similar to what we saw earlier for ExxonMobil. Free cash flow is all over the place in reality, and again, like ExxonMobil, 2021, 2022 were record years for this stock. Free cash flow margins were tremendously high at about 25%, which when you consider where they were in 2014, 2015, and 2016, it's a pretty remarkable change in performance. But again, it's because they're so heavily reliant on oil prices. Now, how does that relate to the dividend? Well, what we have to understand is during time periods like 2022 and 2021, when they were generating so much free cash flow, is the stock paid out a lot of special dividends. In fact, if we take a closer look at that on Seeking Alpha, look at the dividend history, you can see there were frequent special dividends paid out during 2022 and 2023. And that continued on a little bit into 2024 as well. So really, looking at these yearly dividends, this doesn't mean the dividend has been increasing. They just haven't been paying out as much in special dividends since free cash flow has fallen back a little bit in the last couple of years after a few years of record profitability. So there you go. Those are 5 dividend stocks that just recently announced dividend increases. Again, like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.